Let's dive a little bit deeper into the action right now with all of our markets reporters. Mike, get us started.
Well, Romaine, U.S. stocks to some degree have brushed off the tweets from President Trump this morning criticizing China, but not so for agricultural commodities. Soybeans in particular fell to a 7-week low today of less than $8.97 a bushel. This is after President Trump criticized China for not increasing American farm imports. Trade war worries have investors simply moving away from the soybean markets. Bloomberg's commodities team reporting that open interest in soybean contracts have actually fallen to a 4-year low. But the weakness today was widespread across several agricultural commodities. Corn, cotton, some wheat contracts were all off more than 1%. And forecasts for cooler weather in the U.S. Midwest are also weighing on prices. The thinking is that relatively benign weather should help crops that were behind on development following a historically rain-soaked planting season. So very weak day for agricultural commodities. Renita.
Mike, while the ag commodities are a little bit more pressured, we do have commodities that double as currencies that are catching a bid, like silver, gold's sister metal. We see silver up for the second straight day. And if you take a look at the chart, you can see some of the action that's been happening. But it's up ahead of the Fed meeting. Silver's rising now as speculators are also piling into more silver options. Now, that combines with the volume of calls and puts, which surged above 218,000 contracts this month. And this, of course, puts it at the highest since November 2010. And that also puts it on as a sign of greater speculative interest in that market. Now, silver comes more into this picture as silver futures head for the biggest monthly gain of the year, and silver-backed ETFs also surged. While we know that bulls are driving this trading in silver and they're betting that it'll catch up to the gains of gold, bears are continuing, or counting rather, on a weakening global manufacturing area to hurt industrial demand. Abigail?
Renita, sticking with the Fed, this chart suggests that the silver bulls may just be disappointed, though silver bears could be pleased. We've looked at it many times. It's of the 10-year yield over the last year. We see last year in 2018 spending much of its time around 3%, and that volatility risk-off period of the fourth quarter driving yields down as investors went into bonds. This year, the Fed becoming more dovish. We see the 10-year yield bouncing off the bottom of this channel. This chart suggests what our guest Ed from Ned Davis was just saying, that a rate cut is priced in. And what can Powell possibly say to stimulate markets more? It really looks like we could see the 10-year yield back up, not just above that 50-day moving average in yellow, but to the top of the trend channel. The last time we went above the 50-day moving average, there was a greater than 40 basis points back up, the RSI rising. All of this, Caroline and Romaine, suggests that we could just see rates rise after the Fed.